For all the same reasons, silver futures margins have not been raised to protect the very large naked officially short bets against silver. Now, with COMEX now reduced to becoming this price taker, the only solution to buy this silver back at market is to buy it back at market. But hey, Houston, there's a problem. Isn't that a saying? Houston, there's a problem. Silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now, US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange currency cross, prompting the US to both accumulate and, the word is, soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise. Let's look at a similar look at the silver futures structure for all the same reasons. They haven't raised margin calls. And you think about it. Take a look at this, which is a protection of very large, naked, official short bets against silver. And with COMEX now reduced to becoming a price taker, the only solution is to buy this silver back at market. As I say, here's the problem. And just noticed, silver's just been reclassified as a critical mineral. And with it in accumulation with Russia, China, and the US has just begun. Probably likely this export ban is almost certain. As I say, there's only one outcome to tightening supply. The offer to sell silver for immediate delivery simply has to rise. So at a contract value of 165,000, and this was the same period, 2020, when they raised margins on silver to 16,000. Again, we saw a bit of a smackdown there. That was 9.7% of the 165,000. It's still 16,000, and we've actually moved higher now. So basically, even though it's slightly higher now, it's still 6.7% of contract value, which is a hell of a lot less. Now, shorter term, as silver broke out above the identified short stops at 44,275, if you remember, we circled this. I've now added a color to that circle, but this is where the circle is, as is this circle at 53. But essentially, it broke out last Thursday. Then UBS belatedly updating their silver spot price to between 44 and 47 per ounce, stating it would bring it in line with their upgraded 3,900 gold forecast made a couple of weeks ago. They also reaffirmed their intention to stay long and would view all pullbacks as buying opportunities in both gold and silver. Interestingly, while they listed all the usual geopolitical industrial tailwinds, fiscal deficit and de-dollarization drivers, the pivot critical mineral reclassification, and the G7-driven global stockpiling agreements were completely missed. Also, G7 began to weigh in price floors for counter China's dominance. So in summary, what this means is that dollar price silver is grossly underpriced versus at the highs in every other currency, led by daily fresh XAG CNY, in other words, silver against the CNY cross, the Chinese cross. It's being driven by Chinese physical stockpiling. And you can see that this is where it's being led from. So silver price floors are being put in place with CME LBMA diluted dollar price silver in the crosshairs for delivery. Now, the consolidative long stop rinsing in silver is healthy. It's just healthy as it takes out low-hanging layers of cell ignition, like people who've borrowed silver from the house, and they've borrowed just about enough to create some cell ignition, but really it's very low hanging because there's very little. Also, everyone is aware of the Fed wrong footing and are once again looking to capitalize on any dips that are offered. Now, following meetings with our Chinese facing liquidity providers, they report fresh Western institutional gold and notably very large silver demand. Following the end of session, we saw the pit. We saw a pit close. We saw a bid pulled sell-off in illiquid conditions, and so there was a dip below 46. And we knew these dips would be short-lived. Sure enough. So the spot silver dip, I say dip, bid pull dip, sub 46 spot into the month and quarter end yesterday. Now, bearing in mind, that 46 spot is roughly 46.17 in futures. So this futures trading around 17 cents higher. So, but that dip triggered enormous buying. It was readily bought, jumped on by Asian buyers overnight, and it drove another high, which was again sold into the London Open and again bought by Asian buyers. And what that did was overnight, and we're talking about Wednesday morning now, it drove another 2011, basically another 2011 high, which is actually the highest print since the all-time high. It was actually 48 and change in spot, but 49.820 in futures. Adding fuel to the fire, silver, that's the silver in CNH, which is essentially Chinese silver, is in massive demand, leading every other silver foreign exchange cross to all-time highs, euro, in every other foreign exchange cross. And given prices being discovered outside the CME LBMA ring fence, there's little doubt underpriced dollar-priced silver will exceed all-time highs. A lot of sideline money has come into play looking for cheap, underpriced dollar silver, price silver, notably adding fuel to the fire, followed a large 370 tons of so-called non-delivery October contracts being called for physical delivery. And there's still 82 tons of non-delivery October silver that has to be loaded out the back door. And while we did expect this fight at 44,275, last line of defense, liquidity providers indicated physical supply so tight resistance would be short-lived as short covering layers would be uncovered. And that's exactly what's going on now. Net of hedging supply, there is sufficient short covering fuel to drive a run into the next staging point of 53.
You know, it's funny. Every few years, someone in the mainstream financial press looks at silver's price, scratches their head and says, strange that it hasn't moved. And every few years, those of us who actually live in this market just smile because we know what's really happening behind the curtain. The silver market isn't some sleepy backwater. It's the most suppressed, the most manipulated, and now perhaps the most strategically critical metal on Earth. See, there's a reason silver has always been a monetary metal, and not just an industrial one. It bridges both worlds. It's money and technology, it's biblical and futuristic, and now it's geopolitical. And for the first time, it's just been reclassified by the United States government as a critical mineral. That might sound like bureaucratic jargon, but make no mistake, it changes the entire landscape. Because once something is labeled critical, it's not just a commodity anymore. It's a national security issue. Silver has become the quiet battlefield in a new global resource war. Think about this. Silver is used in virtually every high-tech, high-defense, and renewable application you can name. The guidance system of a cruise missile, about 500 ounces of silver. The control chips inside Patriot and Tomahawk systems, silver. Every solar panel, every electric vehicle, every semiconductor fabrication line, all of them rely on this metal. So when you see headlines about de-dollarization, supply chain decoupling, or BRICS building their own payment system, remember that it's not just about currency. It's about control over tangible resources. And right now, the West is losing that control. We're watching Russia and China, two of the largest silver consumers for military and industrial purposes, quietly stockpiling physical metal. This isn't rumor, it's showing up in cross-currency charts. When you look at silver priced in yuan, in rubles, in euros, it's breaking record highs almost daily. The only place it looks calm is in US dollar terms, because that's the one market still papered over with leverage. Now here's where the story gets wild. For all the same reasons that the gold futures market has become a joke, silver futures on the COMEX are even worse. The leverage is off the charts. The paper claims to metal outnumber the available ounces by hundreds to one. And yet, despite this, the CME Group, the very exchange that regulates silver futures, hasn't raised margins to protect against these massive naked short positions. You heard that right. The largest unhedged, officially sanctioned short bets against any commodity in history, silver, are being left untouched. Normally, when volatility spikes, exchanges hike margin requirements to protect participants from cascading losses. That's what they did in 2020 when silver hit $30. But now, even with silver breaking out above $45, $46, even testing the 2011 highs, the margins haven't been raised. Why? Because doing so would expose the shorts. If margin requirements were raised right now, the short players, mostly bullion banks and official market makers, would be forced to post billions in collateral. They'd have to cover, and that would ignite the mother of all short squeezes. So the exchange keeps the leverage as is. It's like watching a poker game where one player keeps borrowing chips from the house, and everyone pretends it's fine. But here's the catch. COMEX has been reduced to a price taker. It no longer sets global silver prices, it reacts to them. The real price discovery is now happening in Asia, in Shanghai, in Hong Kong, in Singapore, where physical silver is being bid for and delivered. When you see the futures price dip in New York, it's almost immediately bought by Asian traders overnight. They smell blood in the water, and that's exactly what's happening right now. The moment silver dipped below $46 recently, it was instantly bought up by Asian demand. Prices rebounded to new highs within hours. UBS even had to update their silver forecast to between $44 and $47 per ounce, a rare admission that they were behind the curve. They also reaffirmed their long position, saying they'd view all pullbacks as buying opportunities. And yet, even UBS, supposedly the most sophisticated institutional voice, completely missed the elephant in the room. The G7's new strategic stockpiling agreements.
Let's start by really looking at exactly who is on the hook here. The banks, along with the Bank of International Settlements, are all long for their own books. We've established that a long time ago. The only banks that are naked short gold are actually the banks that stick handle the Fed's short gold position. So it's important to understand that. No bullion bank is short for their own book. So what is it? It's the Fed. That's the only central bank still exposed to a net short derivative book. And while this is transparently evident in the hard-to-hide COMEX futures market footprints, where we can tie auditable monthly Fed repayments back to the BIS, as we have in every single episode we've tracked the Fed being actually forced to buy back their short-sold lease borrowings into a series of higher prices. Now, it's the larger over-the-counter naked short unallocated bets in the OCC report that you refer to, which is where the real gold derivative problem actually lays. Now, every well-connected physical facing liquidity provider we deal with backs up our assertion and well-founded empirical evidence that these very, very large, undeliverable, unallocated OCC gold bets. And remember, OCC just simply means the report that the Office of the Comptroller, and we've shown how suddenly the 5-year and longer bets were starting to be cut down, which told us, it was just one more thing that told us someone wanted to get out of Dodge. And so really, and it's these bets that are still outstanding is all that remains to so-called hedge these rehypothecated double ownership claims on a yet unknown percentage of the 8,133 tons of US Treasury gold. Or put another way, yet to be repaid US Treasury lease positions. We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher.
Let's pick up right where we left off, because what's happening right now in silver is not just a technical breakout, it's a systemic breakdown of the old order. For decades, the Western bullion banking system has controlled price discovery through synthetic supply. A mountain of unbacked paper contracts layered over a shrinking pool of physical metal. But that illusion is cracking. The paper tail can't wag the physical dog anymore. In the last few weeks alone, silver priced in nearly every major foreign exchange cross, yuan, yen, euro, pound, has hit all-time highs. Only the US dollar price remains artificially low. And that's not a coincidence. That's the firewall. The CME and LBMA, two pillars of dollar-based price discovery, are being used to keep the illusion alive just a little longer. But even that firewall is starting to crumble. You can see it in the way Asia is leading every rally. Every dip during New York trading hours gets immediately bought in Shanghai, and the price is bid right back up overnight. That's not speculative retail. That's institutional and sovereign money moving physical ounces. And here's the kicker. They're not playing for short-term profit. They're accumulating metal as a hedge against geopolitical fracture, because silver has just been reclassified by the U.S. Geological Survey as a critical mineral, a recognition that it's essential to national security and industrial independence. That's not just a symbolic label, it's a policy shift. It means Washington now considers silver a strategic asset in the same category as rare earths, lithium, and uranium. And once a metal becomes critical, you start seeing export restrictions. We've already seen it with gallium and germanium out of China, and with graphite too. The United States is poised to respond in kind. Word is circulating in Washington, quietly behind closed doors, that a silver export ban is being drafted, modeled after the export control framework used for critical defense inputs. Now imagine that. The world's biggest industrial and financial consumer of silver, the United States, cutting off exports just as global inventories are collapsing. There's only one possible outcome to tightening supply in a market where demand is both inelastic and soaring. The price must rise, and not just rise, repriced. Because here's what's really happening under the hood. COMEX futures margins, the deposits traders must post to control large positions, have not been raised in line with silver's rally. Back in 2020, when silver hit $30, margin requirements were raised to $16,000 per contract, which was 9.7% of contract value at the time. Today, even though silver's around $46, margin requirements are still roughly $16,000, only 6.7% of contract value. That's criminally low. Why does that matter? Because it means the large institutional shorts, the same bullion banks and official entities that have been suppressing silver for decades, are still running massive under-collateralized positions. And when those shorts are forced to cover, they'll have to buy back at market. There's no other way out. But with COMEX now a price taker instead of a price setter, where do they buy it back? They can't conjure physical metal out of thin air. They'll have to chase it in the open market, where supply is vanishing and Asia's setting the bid. That's the real Houston, we have a problem moment. And it's not theoretical. We're already seeing physical tightness like never before. Large commercial hedgers and liquidity providers report that wholesale supply is being bid away before it even hits the open market. Refineries are months behind on delivery commitments. Mints are rationing blanks. Premiums on sovereign coins are creeping higher even in supposedly quiet months. Even the big banks are quietly admitting it. UBS just upgraded its silver forecast to $47, matching their $3,900 gold target. And they're telling clients, in private notes, not press releases, that they'll view all pullbacks as buying opportunities. Yet they've completely missed the drivers behind this rally: the reclassification as a critical mineral, the looming export restrictions, the G7's coordinated stockpiling policy, and China's industrial hoarding. That's the real story. See, China isn't just buying silver for solar panels anymore. They're buying it for strategic stockpiles. The People's Bank of China and several state-linked industrial conglomerates have been aggressively purchasing silver through both domestic and offshore channels, often via intermediaries to avoid drawing attention. And we can track it in the data. Silver priced in yuan, the XAG/CNY cross, is at record highs. That's where price discovery has moved. It's not happening in New York, it's happening in Shanghai. In fact, silver in China is now leading every other currency crossed to new highs, and that divergence is widening. That's what happens when real demand, physical demand, overwhelms synthetic supply. Even the CME's own liquidity providers are reporting that Chinese buyers are consistently taking the other side of Western sell-offs. The pattern has become almost mechanical. New York dumps contracts, Asia buys the dip, price rips higher into the next session. It's the mirror image of what used to happen 15 years ago. Back then, Western paper traders set the tone and Asia followed. Now it's reversed. The CME and LBMA have been ring-fenced, their role reduced to a backwater of price discovery for diluted dollar silver, as one trader recently called it. Meanwhile, delivery requests are exploding. In October alone, 370 tons of silver were called for physical delivery, a staggering figure. Another 82 tons are still pending loadout, waiting to exit the back door of COMEX vaults. That's over 450 tons of metal being physically withdrawn in just one delivery cycle. That's not trading, that's evacuation. And when you combine that with G7 strategic stockpiling, with Russia and China openly accumulating, and with whispers of a US export ban, the message is clear. Silver is no longer just a commodity. It's a weapon of economic sovereignty.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.